All right, well, I show 1202, and as promised, we'll get started. Thank you for joining us today. My name is Tim DeSetti. I'm joined with my esteemed colleagues, Ray Evans and Jim Stanziola. I say esteemed because by the gray hair that you're seeing on the screen, we've earned the right to present today on the three of the most important topics that you should be addressing in your 60s and 70s. Yep, that qualifies us. And again, we're excited to be here today. Let me remind you that today's meeting is being recorded. So you'll see that button to accept that on your screen as well. Because it's being recorded, in about 1 week, we will have this presentation up on our resources page, and we'll give you more information about how to access this presentation, as well as this is a third presentation in a three-part series. Each of the last 2 weeks on Wednesday, we've had some of the other fellow advisors on our team presenting on the concepts to master in your 20s and 30s. That was 2 weeks ago. Last week, we presented on the financial planning areas to focus on in your 40s and 50s, which brings us to our current decade. So again, those presentations, I believe, are already on the resources page on our website. I would strongly encourage you to share those, maybe in particular with the 20s and 30s presentation. All of us know in the financial planning business that the most important thing to do in preparing for retirement in particular is to start early. And so there are some great presentations by some of our young advisors. Share that with your grandchildren, share that with your children, share that with your neighbor, your nephew, anybody that's important to you that's a young person, because that can make a huge impact in the future of their long-term finances. So with that in mind, let's get started. I'm going to address the areas of Social Security and Medicare planning. Today's presentation from this minute forward should be about 30, maybe 35 minutes. So we're going to go high level today and then direct you back to full-length presentations on most of these topics. Again, we'll cover that at the end. Then Ray will take over and talk about investment strategy and how that needs to change in your retirement. And then finally, we'll be creating a lasting legacy. Estate planning is critically important. And Jim, our attorney and friend and financial advisor colleague, will cover that last section. So with that in mind, let's jump right in. It's interesting, in the last 10 or 15 years, those of us in the financial planning business have gotten to almost memorize this formula for when is your full retirement age. It's always ranged between 66 and 67, according to the schedule that you see on the left here. Over the next 5 years, we're not going to have to worry about this anymore. By the year 2030, everyone will either be subject to a 67 full retirement age, or they may be delaying out to age 70. But again, the phase out of this 66 in 2 months, 4 months, 6 months, that will gradually phase out over the next 5 years to where we can simplify our mind and know that full retirement is 67. But it's important to be aware if you're not going to be 67 by that date, because you need to know the exact month at which you can take what we call the FRA. You'll see that on your screen there. Why is that important? It makes a big financial difference what month or year you choose to start your benefits. In the center of the screen, you see the bright blue. We've chosen $1,000 benefit just as a sample example of a particular person's benefit at 67 full retirement age. And we choose that number so that you can do the easy math and see that the earliest you could take it on the far left is age 62. And you can see the difference in the numbers. That's a 30% discount. So again, receiving 30% less in benefits by taking it its earliest phase. You can also see that on the far right that you receive a 24% bonus, so to speak, for delaying your retirement to the maximum age of 70. So again, just as a starting point, quick reference, it really does matter. Probably the most significant thing about when to take it is if you're thinking about taking an early retirement as your choice. And so in light of that, I would make it, try to make it very clear that you should think long and hard about taking an early benefit, especially if you're going to continue to work in any form or fashion. the top blue section here indicates that if you do elect Social Security early, understand that there's a very, very clear and punitive rule that they're going to take back $1 for every $2 you earn above 21,240. That is a number that's indexed based on 2025. That number tends to change. So be tracking that if you're taking early retirement. The middle section describes something that's often overlooked by people. In fact, very few retirees think about the fact that what you make in the year of your full retirement matters as well. Many clients, maybe have a benefit. Maybe they turn 67 in February, March. If that's the case and you decide to retire on your full retirement date, you're not going to have much earned income in that first month or two of the year. But let's say that you retire in October and full 67 is when you turn 67 in October. You're going to have almost a 3/4 of a full year's worth of compensation being paid to you. And so how much you earn in the year of retirement at age 67 really does matter. Right now, that's $1 of penalty, so to speak, or reduction for every $3 above the $56,000 level. So again, it's important if you retire early, it's important to pay attention to on the year in which you turn full retirement age. But if you wait till that full age 67 and you retire after that particular year, there's no limit on how much earnings. You can go back to work, you can stay working. In fact, at age 70, obviously I think we all are aware that you have to take your Social Security by age 70. Again, this is just a quick example, and I'm not going to get too detailed for the sake of time today, but it gives you the mathematics of what taking those early benefits can do. If you make $45,000 and you know that an early retirement limit is $21,240, as mentioned, you've earned on the far right $23,000 more than what you were allowed to make. They're going to take from your monthly benefit one of every $2 or half of that amount over the excess. So you can see that in this particular case, this dramatically reduces what the person actually receives in Social Security. So again, just an extra word of caution to be very aware of those penalties. The next two slides I want to cover with you are going to be changing. I know each of us are going to talk, both Jim and Ray, a little bit about, we'll probably reference the fact that we do have a new income tax law in that one big, beautiful bill that was recently passed. If you've been listening to the news, you heard it advertised early in the year that, perhaps your Social Security would no longer be taxed under under potential new regulations. That could be true, that could not be true. So it's technically, there will be some added benefits to your Social Security. And so I think it's going to be really important for you to meet with your financial advisor. Very, very soon, we're going to have all of our planning software updated with a new big, beautiful bill. And we'll be able to run projections for you on how much of, perhaps how much reduction in tax, or if there is an elimination of tax on your particular Social Security benefits. But again, it's a simple formula that they try to make complicated. It's basically your modified adjusted gross income. Only half of your Social Security benefits count towards the calculation to equal what's called your combined income. So again, the important thing to take away here is meet with your advisor here in the next month or two as we become very clear and our software is updated, and we'll run those calculations for you. Again, taxation of Social Security benefits is really dependent upon your income. And again, these numbers are a moving target. So I won't go into too much detail here, but again, you could qualify for no tax. On the middle column, you could qualify for potentially half of your benefits being taxed, or as much as 85% of your money being taxed. So again, we look forward to working with you on that calculation as it applies to you. Quickly, I'll transition and cover Medicare. Again, these are complicated areas, but I know many of our clients are, as they approach the age of 65, you really need to be very, very thoughtful about and gain an understanding of each of these parts of Medicare. Part A is simple, comes to you at no cost. Everyone receives it. It's your quote unquote hospitalization coverage, a little bit of a outline of what's covered there. Part B is as well mandatory. Once you elect Social Security, you'll be enrolled in Part B as well. The bad news is you have to pay for Part B, and they take that right out of your Social Security check. Currently, I think I'm maybe off by $1 or $2, but I believe it's running right around $185 a month per person that will be reduced from your Social Security, or you'll receive a quarterly bill if you're not taking Social Security yet. And that's to cover all the doctor visits and outpatient care. Again, a quick reference there. What we all probably know is that Part A and Part B don't close all the gaps of the potentially very expensive cost of healthcare benefits in retirement. And so you generally have two options. One is you can take Part D and your Medicare supplement program, or you can elect to use on the right, you can use what's called Medicare Advantage. And so this is a very important decision, the most important decision, in my opinion, about this process of electing Medicare. Later, at the end of the presentation, actually, I think at the end of my section here, I'm going to give you some more information. We have an upcoming presentation regarding this, and we'll cover probably a full 45-minute presentation on how to properly make this choice. So again, today's maybe more of a teaser to that upcoming information. Also on our resources page, we have the full presentation from last year. We make an annual presentation of this because it is so important to all of you. But again, remember the two important steps. Step one, you need to enroll in the original Medicare. It's mandatory. There's penalties in place if you don't enroll in Part 1, Part A. Again, step two is the complicated part where you need to choose from below either option 1 or option 2 to get private. Option 1 would be your private insurance. That allows you a lot of flexibility. It allows you to, in many cases, go to any doctor and any hospital network. Option 2 is the Medicare Advantage, which can be far more economically, at least it would appear, cheaper in the way of premium, in some cases free, but you do have some limitations there. And so it's something you need to really, really think through and tune in to our full Medicare presentation. With that in mind, I'll call your attention to, again, in light blue here in the middle of the page, you'll see infinitalkskc.com/events. I believe the registration is already available. If not, it'll be coming out very soon. Grant George with Medicare Done Professionally is a local resource, someone we've partnered with in the past. And on August 27th, they'll be presenting at noon in this same format. So again, look to those resources. I'll also remind you that you may be having questions right now. If you have a question about what I just presented, maybe jot that down because we will be opening the presentation to questions at the end of Ray and Jim's presentation. So sorry, I should have mentioned that early. With that in mind, Ray, I'm going to turn it over to your segment of the presentation on investment strategy, and I'll take you right up to your first slide.
Thank you very much. Great job, Tim. Appreciate it. So a couple things going on regarding when and how to take money out in retirement. A couple things compared to previous years. You know, it used to be 25, 30 years ago, life expectancies were such that people tended to work until their mid-60s or later. And then we tended to get fairly conservative with their portfolio in retirement. The thought being they didn't have time, should the stock market bounce around, to recover from significant losses, particularly if they are starting withdrawals and taking money out. So in our mind, it makes sense to have a little bit of a different stance from accumulation mode, most of your working career as you're building assets and building a portfolio and some savings, to withdrawal mode, and perhaps the need at that point in time to have a little less volatility associated with your portfolio. Want to emphasize everybody's a little bit different. Everybody's risk tolerance is a little bit different. But the main thing that's also occurred with that in the last 30 or 35 years, interest rates on bonds and CDs have gone down. Lifespans have gone up. So where we used to be quite conservative coming out of the gate as we hit retirement, Now we've got a fairly balanced portfolio with people. And this is a little bit busy, but one of the things that we talk about is centering on a 4 or 5% withdrawal rate as somebody starts and initiates withdrawals in retirement. 4% rule is a common one that's used. And one that we like a lot is the 4% rule. And lots of people take out more than 4%, but it's been relatively proven through rolling 30-year periods. We choose 30 years because that now is not an unconventional retirement time period, that a portfolio approximately 60% stocks and 40% bonds, taking 4% out a year and inflating that distribution rate by 3%, the rate of inflation, that entire time period, all rolling 30-year periods at a 60-40 stocks to bonds portfolio, never run out of money. So that's an important starting point for that. For us, not everybody can afford to either take that 60% allocation to stocks from a risk tolerance standpoint, or they might need more money to take out. And certainly we've made 6 and 7 and 9% distribution rates last, but it's much more difficult as you go through stock market volatility. And Tim will go to the next slide. Thank you. So again, taking risk, it's a little bit harder with age. We actually, on our end, get a tad bit concerned after a couple of good market years where we're talking to several clients who might be retired. And because they've had 2 good years in a row, particularly 2023, 2024, oftentimes that raises their allocation to stocks, which is great as long as their risk tolerance can handle that. But currently, we're meeting with a lot of clients who typically have been maybe 55, 60, 65% stocks, but because their portfolios have advanced over the last couple of years, they're 70, 75% stocks. And it's a real point of emphasis for us to encourage them to rebalance. And it's not because we're particularly worried one way or another about short-term market movements. But as you're taking money out of a portfolio, obviously part of our task is to try to grow it to compensate for the amount that you're taking out. So if somebody has a 5% withdrawal rate, we want to make sure that we are taking their portfolio or setting it up in an allocation that allows them to replace that 5% withdrawal rate or whatever they're taking out year to year. Conversely, if they're 75% in stocks and they may have a higher allocation to stocks than they need, and if, for example, you have a repeat of March when we had a lot of volatility in the markets, S&P went down 19% over about 6 weeks, that can cause a lot of concern for somebody who is taking money out. So again, a couple things to this point to think about. Retirement's a longer time period than it used to be. So we probably have to have a higher allocation to stocks than we did 25 or 30 years ago. We certainly measure that with somebody's risk tolerance, and we take great pains at the start of the process to make sure we understand what that might be, but also to get a good impact on the impact of the safe investments, CDs and bonds, which now we're paying somewhere in the 4% range, much better than 3 or 4 years ago when we were looking at 1% yields. So I'll go to the next slide. Thank you. So one of the things we do is drill down to a great degree on what expenses somebody has that are both fixed and variable. And as a result, where in their portfolio are we going to be taking the money from to help fulfill those expenses? So if you can take just a second on this, and you might look at the very bottom of this pyramid, what is the stable spending that somebody might have? And that might be their living costs or something that doesn't change too much month to month. And certainly we would look at things like Social Security if they have a pension, but things that pay a defined amount of money coming out as trying to cover those objectives primarily. Variable spending includes things like travel or things we might do that are more fun at different points in the year. And we often will look inside their portfolio at that time and see where we can take those assets from to fulfill those expenses and the fact that they may change on a regular basis. It's interesting, in the old days, we used to get the idea that when someone retired, their retirement expenses were perhaps 70 to 75% of what they were while they were working. We don't find that to be the case anymore. I think a lot of us, when we retire, feel really good and want to have a lot of fun in our retirement years. And so we don't see a lot of expense reduction in those early years of retirement. So that's when we have to pay particular attention to the portfolio and where we can tax effectively take money out to satisfy those expenses. And then also at the very top of that pyramid are the legacy oriented assets. We've got several clients who have owned certain stocks for a long period of time in their personal accounts and have very high unrealized gains. It's not tax efficient to sell those things if we can avoid doing that. And so those are assets that we will try to hold on and make part of the next generation and part of their legacy planning. Go to the next slide. Thank you. And so this is a little busy, but I'll encourage you to focus on the very bottom half of this page. And this talks about the range of returns for stocks and bonds and then blended portfolio. So if you can focus on this, there are 1-year time periods, 5-year time periods, 10-year rolling time periods, and 20-year rolling time periods. And this goes back to 1950. So when you hear the term rolling time period, a 5-year rolling time period, the first one might be 1950 to 1954. The second one, 1951 to 1955, and so on. And the blue, dark blue line or dark blue box are stocks. The gray box are bonds. And then the light blue is a 50% stock, 50% bond portfolio. So if you look at the 1-year column, the way to read this, and let's just focus on the stocks, the dark blue, the range of 1-year returns since 1950 has been pretty dramatic. We've had a year with a 52% gain, and we also had a year with a 37% loss. So if somebody comes to us and says, here's some money that I'm going to need in 1 year, we are typically pretty careful to not put 100% of that money in stocks because the range of returns is so dramatic and in over a 1-year time period that we would encourage them to be much more cautious with that money. Same column or same 1-year look here and look at the gray or black box and look at the range of return for bonds. Typically bonds are pretty conservative. You've actually had years where bonds have appreciated pretty dramatically, but we've also had years where there's been a negative return. Conversely, a 50-50 portfolio has about the same range of returns as an all bond portfolio. And as I start to sit there and look at this over longer periods of time, it's pretty clear the longer time period I have, the volatility associated with stocks tends to mute quite a bit. So we met with a client the other day who had some money set aside that they are going to put into a new home in somewhere around 9 to 12 months. Well, that's not money that we felt comfortable allocating to stocks. At the same time, they had some other money that is oriented toward taking money out on a longer term basis. And that was where we started to design a portfolio with them that we ultimately came to about a 60% stock, 40% bond mix, with a heavy emphasis on the stock side to dividend-oriented securities, perhaps less volatile stocks than they have had during their accumulation phase. So those are some of the decisions that go into designing a portfolio, where I take money from in retirement to augment Social Security and perhaps pensions that I might have. And Tim, if you can flash forward one more, I'll set up Jim here. So that kind of gets us to the top of that pyramid and some of the key elements that we need to be thoughtful of as we want to leave assets or create some sort of legacy, which may include charitable endeavors with parts of our savings and our portfolio. Jim, take charge here.
All right. Thank you, Ray. Ray mentioned the 4% rule and how important that is in terms of determining how much to take out during your retirement. And it's a time-tested rule along those lines. I have kind of my own 4% rule, and that is consider taking 4% of your time and devote it to retirement, investment, and estate planning. And I think you'll find that that's going to set you and your family up for success. So that's my own 4% rule. Anyways, estate planning. Let's first talk about gifting What used to be the saying, and still is to a certain degree, the only two certainties in life are death and taxes. Not so much with gift and estate taxes anymore. How things have changed since the year 2000. With respect to gifting, we had a $10,000 annual exclusion, and that's been adjusted for inflation over the years. Roll the clock forward to 2025. It's $19,000 per person per year, or if you're married, a couple can give $38,000 to a child. It doesn't have to be a child, but it's per person per year. So there's some flexibility there. And it's really even better than that if you roll to the next screen. I had someone come to me and say, I have some real estate and I want to give it to my kids, but, I only have a $19,000 annual exclusion. Well, I said, it's real easy to do what you want to do. That the real estate was worth about $400,000. And all you have to do is tap into your federal lifetime gift exemption, which this year per person is $13,990,000. So that person could just take that $400,000 asset, gift it to their children, not pay any gift taxes. All you have to do is file a gift tax return, let the IRS know that you're using $400,000 of your $13,990,000 gift exemption. That's a lifetime exemption as opposed to the $19,000 per person per year annual exclusion. The 2017 Tax Cuts and Jobs Act jumped it from 5 million to 10 million. So that was a big increase. And then it has been periodically adjusted to the $13,990,000 per person per year. And the sunset that was scheduled to happen January 1st, 2026 has been eliminated by the One Big Beautiful Bill Act, effective January 1st, 2026. Going into next year, we will each have a federal estate gift and generation skipping tax exemption of $15 million, which if you're married, you can protect $30 million of asset value. So unless you have an estate exceeding 30 million, you will not be in an estate tax situation. So one of the things that is important here in my mind in terms of looking at estate tax versus paying income tax. What we still have in the law today is what we refer to as a carryover basis at death, which is sometimes referred to as a step-up basis at death for appreciated assets. If you bought a stock that was worth next to nothing and it grew to $1 million at your death and you turned around as a part of your legacy and gave it to your children, they could turn around and sell that $1 million stock for $1 million and not pay any capital gains tax because they would get a new step up in basis of $1 million. So the fair market value at death, $1 million, the cost basis for income tax purposes, $1 million, zero capital gain. That's still in the law. There was a push a few years ago to try to eliminate that. We still have that today, and I'm glad that didn't get eliminated. So our kids, our heirs, do not have to figure out what our original cost was in that asset. They get a new step up in basis at our death. Remember, a lot of people have assets in qualified plans. That's a great place to have assets for retirement. Those assets grow in those plans tax deferred, which is very nice, but those assets do not qualify for a step up in basis. It would only be assets outside of a qualified plan that is considered a capital asset, like a stock or really almost any other real estate asset. Most other assets would qualify along those lines. Now, keep this in mind. I have a lot of clients who come to us and say, "Hey, can you take a look at my estate plan?" And their plan typically was done prior to 2018. And in 2018, there was a big change in the law. And I'm going to explain that in a moment. But if your estate plan was done prior to 2018, you probably need to take a hard look at it because it probably is going to need to be updated. Most estate plans done prior to 2018 used a formula provision to fund what I refer to as a family trust, which is designed to be outside of the estate at the second death if you're married, to avoid paying estate taxes. And that was done because if you didn't do that, for the first decedent, the first spouse to die, you either used or lost your exemption, which was big. So to preserve your exemption, we stuck it in this family trust. Well, in 2018, Congress gave this new concept called portability, meaning you no longer have to do that. The surviving spouse can use your exemption at your death without funding the family trust with the exemption at the first death. Why is that important? Well, it gets back to the step up in basis. Assets that flow into the family trust do not get a step up in basis because they are not included in your estate for estate tax purposes. The short end of it, and I know that's kind of technical, but the short end of it is if you have a plan that has not been updated since 2017, you might want to take a look at it so that you don't deliver a tax problem to your kids. Next slide, please. So I'm going to wrap up the discussion on estate planning, and as Tim pointed out, this is a high-level overview, but all of these concepts are really important in my mind. In terms of planning, do it while you're healthy, and this holds true not only for estate planning, but for any type of planning, whether it's investment, retirement planning, what have you. It is always easier to make decisions, to have a little bit of a runway in terms of what you feel is the best for you. The earlier you plan, typically, the better the result down the road. With estate planning, obviously you want to have the right distribution in place. You want to avoid probate. Probate is a public process. It's expensive. It takes at least 6 months to go through, and it's a process that you want to avoid. Just one quick comment on distribution. Obviously, I'm stating the obvious in terms of having the right distribution in place, but consider asset protecting your legacy. Whatever it is that you are going to leave to someone, to your children, for example, consider some options where you give them assets for their benefit that they can use to support their lifestyle, but also free them up from having that money be subject to any potential undue influences that they may experience during their lifetime, whether it's a bad marriage, auto liability, or any of the unfortunate things that could happen to someone as they move forward in life. Another critical concept with respect to estate planning and having the right estate plan, you can have the nicest looking documents in the world, but if you don't have the right titling and the right beneficiary designations on your retirement plans and your other assets like life insurance, your estate plan is just not going to be very effective. So we do spend a lot of time here at InfiniTALKS and Stanziola Estate Law to make sure that your assets are properly coordinated with your estate plan along those lines. You're just going to get the best result by spending the time making sure that those assets are coordinated with your estate plan. Obviously, it is important to have healthcare directives and durable powers of attorney. Just real quickly on those, these are two documents that apply during your lifetime. They don't have anything to do with distribution, but they are very important documents. The healthcare directive allows you to appoint someone as your agent in the event you are incapacitated, even temporarily. Otherwise, if you do not have that document, your spouse, if you're married, will not be able to, for example, will not be able to make healthcare decisions on your behalf or get access to your medical records without a healthcare directive. It would ultimately be a committee at the hospital that would make those decisions on your behalf. Another very important document during your lifetime is a durable power of attorney for financial decisions, where you are appointing someone that in the event you cannot manage your financial affairs, even temporarily, you have someone who can pay your medical bills, who can manage your assets to make sure that you still are moving forward in life in the most optimum way. And that is also a very important document. One last comment with respect to healthcare directives and durable powers of attorney is you have basically two ways of doing those. The one way that I like doing them is to basically have those documents become effective immediately upon signing, meaning you are not required, or your agent is not required, to have you certified incapacitated. Typically, it might be difficult to find a physician on the spur of the moment to certify that you're incapacitated. There's probably going to be a charge for that. You can skip that step and just make the document effective immediately upon signing. You still have to be incapacitated. You just don't need to be certified incapacitated. Now, for someone who does want a third party to make that decision, like a physician, and go through that certification process, that's perfectly fine. We can do those documents that way as well. But just keep that in mind in terms of the additional flexibility that might occur by being able to avoid having to find someone to certify incapacitation. So just to sum up, effective estate planning is done while you're healthy, and the right distribution. Consider asset protecting your distribution to your heirs, and coordinate your assets with your estate plan so that none of your assets go through this process we describe as probate. So that, in a nutshell, is the estate planning update, and I will pass it back to you, Tim.
You bet. Thanks, Jim. I'm going to have Lauren unmute all of your lines, at least give you the ability to unmute your own line so that we can open the floor for questions. While she's doing that, I would call your attention to both, obviously, our office phone number where you can ask for your advisor. You can shoot an email. Lauren receives these emails at InfiniTALKS, info@infinitalkskc.com. She'll be sure to pass that on to you. And then our web address is where I referenced the resources page. We've got some, oops, sorry, I didn't mean to jump past that. We've got a great resources tab where you can see all of our past presentations. Jim and I and other advisors have done presentations on estate planning, lots of investment, market updates, Social Security, Medicare. Every topic today, you'll see a deeper dive. And we will have also upcoming events listed at the bottom of that page on the resources tab. So with that in mind, if someone has some questions, the floor is should be open for you to unmute yourself.
how does the required minimum distribution that you're required to start at a certain age and then your 4% each year work out?
Yeah, Ray, I'll let you take that.
Yeah, I'll jump into that. Thank you. Good question. So based on when you're born and how much money you've got in your IRA, you have a required minimum distribution for, under current law, starts to kick in at age 73 currently. And it's based on your life expectancy, and it's based on a January 31 published table every year for male and female, based on life expectancies. So that calculation is done, and let's just say that number is $10,000 a year. Just turns out to be $10,000 from your IRA. You have to make sure that at least that amount comes out. It can be paid directly to you, or it can go into your personal account, and that's taxed as ordinary income. If you don't take the minimum out, there's a 50% penalty on that amount that needed to come out. So all of us are very conscious and thoughtful. I mean, it's July right now, and we're already talking to many of our clients regarding the fact that they may not have taken out all of their required distribution. But if what you need to live on exceeds that $10,000 in this example, we typically will then look to your personal assets if you have them, because the tax treatment is usually a little bit more advantageous than the ordinary income tax you'd pay from your required distribution. So that's usually where we would go to somebody's personal account and say, okay, what can we sell or what can we take from, and what series of transactions could we potentially do that are somewhat tax neutral or tax efficient? And so that's where the remainder of what someone might need. Typically, that's the next step we would take. Sometimes we have to take it all from the IRA and pay ordinary income tax on it.
And there was a follow-up question with that regarding a 4% rule. Of course, the 4% rule doesn't have anything to do technically with the required minimum distribution, but it does just so happen that most people's required distribution around age 73 does, come out to about that amount. It's typically 3 or 4%. And if you don't turn 73 before the year 2033, the required distribution is being phased in up to age 75. So it's possible your required distribution might not be until 75. Again, I think beyond any more detail than that, I would encourage you to reach out to your advisor. We can certainly calculate that directly for you. Even if it's a few years away, we can probably give you a pretty good estimate about what that's going to be and how to handle that.
I have a Medicare specific question. Is that
sure?
Okay. Okay. So I currently am working, 65 years old and still working, and I signed up for Medicare because pretty much it seemed like you needed to do that at 65, but I'm not really using Medicare today. I'm being insured by my my current employer, large employer. And so my question is around HSAs. I can't get a person at the government to respond to this, but you're supposed to stop funding HSA accounts when you sign up for Medicare. And I'm technically signed up, but I'm not using Medicare. So,
yep.
You know what the rule on that is by any chance?
Yeah, the unfortunate news here is that as soon as you sign up for Medicare, whether you're using it or not, you may no longer contribute to your health savings account.
Okay. And then the second part of that, I had one additional portion to that. I know the Part B you're supposed to sign up for within a certain number of months after you no longer have insurance through your employer. Is that then the start date, whatever you decide to do? If I know it's like 6 months or 8 months or something, whatever you do, is that the actual starting date?
Yeah, as soon as you leave employment, that's considered a qualifying event. And so it would activate your Medicare Part A, Part B, and then would also activate your you should have your supplement in place at that time so that you have no restriction on, pre-existing condition or anything like that. Because if you choose a private Medicare supplement, you're going to want to do that under a qualifying event. You're not going to want to go through, an approval process that might, be restricted by a pre-existing condition.
Okay. And then last part, I am married. Can you fund an HSA under your wife's name if she is not 65 and not in the same position?
Yep, provided they have a qualifying high deductible plan, in other words, one that's allowed to combine with an HSA, they can put their contribution limit into the HSA. So
okay,
Yep.
in a certain account that's just their name, is that correct?
Yeah, it'd be their
Okay.
HSA. Yeah, your spouse's HSA can continue to be funded until the time that they choose to elect Medicare. You brought up an important point, and this is a little bit probably a little bit of salt in your wound there, because and this depends on your employer. So you may have been required to sign up for Medicare, even though your employer is providing your primary insurance. Some people can avoid signing up for Medicare all the way until they retire. Maybe that's, age 68, 69, 70. So long as they don't elect Medicare, they can continue to fund that HSA past the age of 65. So it's a little bit of a complicated rule. Check with your advisor. Tune into our Medicare presentation next month if you're not in this gentleman's situation and wanting to know more detail about that very situation. HSAs are terrific, but they will get taken away from you upon Medicare.
Sure. Okay. Thank you.
Yeah. Other questions today?
Yes, good afternoon. My question is around Form 706. I was advised by a friend that I should complete this. My spouse had passed away 2 years ago.
Yeah.
Would you be able to elaborate on what that is specifically, and if there's a deadline for that?
Yeah, that's a really good question. So Form 706 is the estate tax return. That is the federal estate tax return. And generally, a lot of people don't have to file an estate tax return. There's two reasons why you would want to file an estate tax return. One is if the decedent who died, sorry to hear, this was your husband, did you say?
Yes, that's correct.
Yeah, well, I'm sorry to hear about that. But with respect, if someone dies and at their death, they owe estate taxes, that is a reason to file an estate tax return. But again, with the large exemptions, federal exemptions that we have, a lot of people, unless you have significant wealth, do not have to be concerned about paying estate taxes. The second reason for filing an estate tax return, which might apply to more people, is wanting to preserve the exemption of the first spouse to die. So I mentioned this concept called portability. And so the IRS has a specific procedure for filing an estate tax return, a Form 706, to get portability. Okay, but you do need to file an estate tax return to do that. Now, when does it have to be filed? The IRS a couple years ago came out with a pretty extended deadline. It only has to be filed within 5 years of the decedent's date of death. So there's quite a runway, which may be a bad thing, in terms of not having an immediate deadline, but there's quite a runway for filing an estate tax return. But if there is any doubt, if there is any concern about having to pay estate taxes at the second death and wanting to tap in the exemption, the federal estate exemption of the first decedent to die, good idea to file a Form 706.
Yeah. The person in the know there probably is giving you good advice, but that'd be something we'd be happy to, give you a second look on.
I appreciate that. And so from what it sounds like, the first step would be to file at least one estate tax return. And then the second step would be to capitalize on the exemption Now, the question is, if, let's say I have less than 15 million from whatever his assets are, would the 706 still be beneficial to apply? Just, I have a long runway. I'm actually
Yep.
under
Yep, that could be the
50.
very reason. Yep, that could be the very reason.
Okay.
Just go ahead and there's no harm in doing it. It gets it on record that you're going to preserve his exemption. If you would, and let's say, well, if you would grow to be worth more than that, you've got a really good investment advisor. Just kidding, at InfiniTALKS. Then you've locked in that preserved exemption.
Okay.
So great
Well,
question.
my advisor is at InfiniTALKS, but I will certainly take that up with him and perhaps reach out to you separately. Thank you so much for your help. I appreciate it.
You betcha. You betcha.
you're
Other
welcome.
questions today? All right. I believe there probably are some more questions out there. If your questions are private, definitely send that to your personal advisor. If you don't have their email, phone number handy, send us a message at info@infinitalkskc.com. You can also go on the website. All of us, the advisors and our support team are all listed on the website under the About Us tab. You can definitely click on us and send us an email, get our contact information. Last call for questions. Anybody?
Kind of along the same vein. My husband passed away almost 6 years ago, and you talked about the step-up basis for assets. My understanding that on home value, that you can do that at their death. You can step up at that time. Is that correct?
Well, yeah, yes. I mean, a house, which is real estate, is considered a capital asset. So how was the house titled? Was it titled in his name, or was it jointly titled?
Jointly.
Yeah. So technically it was owned 50-50 between the two of you, right?
Correct.
So at his death, a half of the house would qualify for a step up in basis. So, depending on how much the house appreciated, you would get a new step up in basis with respect to half of the house.
Okay. Is that something that should be done now versus when the house is sold?
Yeah, it's really about documentation there, don't you think, Jim? I mean, I think
Correct.
the important thing is to have documented records of what you believe the house was worth at that time.
Yeah.
And then homes themselves, personal homes, have a pretty large exemption from capital gains. So it's quite possible you'll fall under that exemption, but documentation here is key. So with your advisor, bring that to their attention and or your CPA. Make sure that you're documenting what the value of the home was and is. And probably be prepared just to make sure that you don't pay any capital gains on your home.
Yes. Okay. Thank you very much.
Yep. And that could come into play at your lifetime or at your passing. So again, condolences on your loss, but a very good question. Thank you. All right, everyone. I have a waiting room visible to me, and I don't see anybody else in the waiting room. So with that in mind, this presentation will be recorded. It'll be up on the website in a couple of weeks, maybe 1 week. Be sure to pass on the 20s and 30s or 40s and 50s to children, grandchildren, anyone that you love and care about. There's some great tips for them at their stage of financial planning. And thank you for joining us again today.
Yeah. Thank you, everybody.
Everybody, appreciate it.